Good evening, good evening, good evening. I'm always on time. Always. I'm going to give everybody a minute to get in before I get started. All right. How crazy we trying to get tonight? Okay. So before I start, we'll cover the boring stuff. My name's Drew, aka Catching Rockets. Tonight we're going to do a quick video. Actually, it will not be quick at all. This will probably take at least an hour and a half, possibly 2 hours. If you can't watch it all in one sitting, I understand. But we're going to cover a lot of information. Basically, what I'll be covering tonight will be enough to take you from being an average trader to being consistently green. If you follow what I say to a T. So that's the goal. So it will be a little bit of a longer video. We're going to be covering POCs, points of control, virgin points of control, value area, volume profile. We're going to touch on volume a little bit. That's something you should definitely focus on yourself. I highly recommend, or actually this is like my mentor's recommendation, but highly recommend reading Volume Price Analysis by Anna Cooling. It's a really, really good book on volume, and without volume you can't trade, but with volume alone you can trade. And then I'm just going to cover a little bit of technical analysis, not a ton, but my goal is by the end of this class today for everybody to be able to go tomorrow and just watch SPY and take trades on SPY all day long and be profitable. And once you can trade SPY and use just a little bit of technical analysis, you can take that and apply it to literally any ticker that you want, and you can be profitable there as well. Really quick, my setup, this screen here, this is ThinkOrSwim. This is my main trading platform. I might cover this if I feel like I have time later, like how I use you know, like a 5 grid. Off my screen I have another 10 charts that I watch at any given time. But I think the main thing is for scalping, I use sorry, I can't think. Active Trader. Words. Found the words. Active Trader in ThinkOrSwim, which is really nice. You can click on your strike prices here directly from your watch list, which will take you directly to the bid and ask for that strike. And then you can choose however many contracts you want, or you can type them in, and then you just click to place your order. Yeah, like here, I would put it, that's a stop limit order if it goes above 2 cents. Anyway, if we have time, we'll look at that later. I do a lot of my charting. Whoa, wrong button. I do a lot of my charting in TradingView because I just like the cleanliness of the platform and the simplicity of taking indicators on and off of my charts. Yeah. Right here on SPY, you can see, what is this, January 18th. And January 19th, we had a double bottom here, or possibly a triple bottom. I'm just showing this since it's on my screen. I put this line on here. January 18th when I saw this double bottom, because I figure it will act as a good entry for future trades. And you can see here, it was a good entry for 2 puts. Anyway, we'll cover that a little bit later. We're going to focus on, I don't know, I'll do Apple. And we're going to start with a blank chart. All right. And I'm going to start on the 30-day, 30-minute. And we're going to turn on our volume profile. So for anybody interested in the volume profile aspect, as far as indicators, you have to pay for like the minimum subscription for TradingView. And once you do that, you would click on indicators and you search for session volume profile session volume. This one here, it's the one that I use. And that will give you your value area, your points of control, and your volume profile. And so what we're going to do from here, so these red lines, oh, actually really quick while I'm thinking about it, if you're using TradingView, you're going to want to double click on one of the volume profiles like here, and you want to change your row size to 200 and your value area to 68. Some people use 70%, some people use 68. My preference is 68. You can use 70% if you want to, but I recommend 68%. It's 2-point deviation. If you don't know what that means, it's not a big deal. Stuff that you can learn later. But those are the settings I use, and those are the settings that I recommend. So once we're here, we're just going to draw in our POCs that are of significance. I use the horizontal ray. I got to turn off my magnet, otherwise I can't get the POCs because it'll try to grab the candles. I'm going to draw in some that are not significant just so we can show the importance of how these act as magnets for price and things of that nature. I mean, you should already be seeing something pretty interesting today on Apple. Touched our value area, I'm sorry, our POC from December 6th today, like almost to the penny. And the chat's pretty busy tonight, so if you guys have questions, I will do like a question and answer portion at the end of the video. Right now, it's too much for me to keep up with while I'm talking, so we'll have to do that later. I can't do it right now. Sorry. So I'll explain this in a little bit, but right now I'm just trying to draw. I wanted to start with a naked chart so you guys can see how I go about charting everything from scratch. Right now, normally I wouldn't take these points of control back here. I'm just grabbing them so I can show you what would happen on future trading days. Once you have these, you're going to want to double click your POCs and you'll type in, so this is a virgin POC like I said. Oh wait, I'm sorry. I do December. I like to know how old they are. So basically when I'm looking at the chart here, I can see right there, oh, this is from December 6th. And I'll explain why that's important as well. I'm not going to put in the dates for all of these. I'll do a couple, just because I'll spend forever sitting here typing in dates. Okay. So I'm going to zoom in on this December 6th point of control really quick. And we're going to start with point of control, and then we'll move on to the volume profile and value area. Um, so you can see this is the gray area or black area here. This is the regular trading day. Um, Blue area is after hours. Brown area is pre-market. And so this point of control, even though it's being touched a bunch of times during the day that it was formed, it remains a point of control until at least the following day. If the price is still trading here on the following day, once it leaves this point of control, if it comes back to it, then it would become just a regular point of control versus a virgin point of control. So she's still a virgin as long as we're trading. It doesn't matter if we leave it during this trading day that it's formed on. It doesn't matter if we come back to it during after hours. What will matter is the following day. So as long as this isn't touched the following day, and again, it's kind of hard to show, but like this one, it did leave it and then come back to it. So this would become a point of control at that point versus a virgin point of control. So our point of controls are super important. And you want to think about it from a psychological perspective. So the point of control is going to be the area on the chart where the most trading took place on any given day. So that includes buying and selling. And it's a very important area because wherever we have the largest amount of buying and selling, that's going to remain a large area for buying and selling on future dates. So these act as major support and resistance, but they also act as a magnet for price action. So price action will get pulled to these POCs. And again, that's point of control. From now on, I'm going to refer to them as POCs because it's just easier. So those POCs act as magnets. And every time a price gets close to them, very good chance it will be pulled down or up to one of those points of control. A virgin point of control is going to be stronger than a regular point of control. Once it's been touched, it loses some of its strength as far as like pulling price to it and also acting as supply or support and resistance. Sorry, 1 second, guys. All right. My dogs are freaking out about something. I don't know what. So trying to remember where I was really quick. Sorry. Okay. So the way that you want to think of points of control is if you are a market maker and we're Apple's down at 166, they already know if Apple's going up or down. And they're going to say, wow, Apple's about to have a good run. I'm going to put in an order here for $500 million of Apple. They're going to use a limit order, whether it be on, dark pools or on the live market. And when they put in that order for whatever, $500 million, obviously price is going to start taking off, either from people seeing that large order on dark pools or from, if they're doing it on the live market, that large order is going to be enough to send the stock up. Market makers are obviously a lot smarter as far as trading is concerned than most retail traders. And so that's where we want to get to the point where we're thinking like them. So they're not smarter than us and they're not clapping our cheeks every day. So if they place this large order here for $500 million of Apple and it takes off and they only get a partial fill, let's say $250 million filled worth of Apple, and then the price ripped up. Market makers don't move their orders up. They leave that order here because they know price will come back down to this virgin point of control. They'll get a fill and it's going to rip up again. And when it was up here, they're already probably sold and took profits and they're waiting for it to come back down so they can get in again and take more profits. Okay? So when the price is cheaper, always think from the market maker's perspective of they placed a large limit order here that got a partial fill. And the next time we come to there, we're probably going to see a bounce because they have an order waiting for the next time the price gets here. Whereas retail investors, and we're going to get a little bit interactive here. Let's say you're a retail investor and you buy stocks, because this doesn't apply to options. Theta changes the game on that. But let's say you as a retail investor buy around this POC here. And then the very next, or that same day, price rips down. And then it rips down further. And then it's down further. And a few days later, you get back here. What are you doing as a retail investor? So think how you would react here if you bought um, a few days back and the price ripped down and you get back to that price. What are you going to do? Hopefully everybody's thinking I would sell break even, because that's what pretty much everybody would do. Um, this is not a great example. Like, this might not look like a lot of support and resistance, but trust me, this is a lot of support and resistance. Um, we're on 30-minute candlesticks here, and the fact that it literally touched this POC and bounced, and then it came back over and pulled back to it, and then went back up again, and then came back down to it again. So over an hour and a half period of time, it was tapping this thing back and forth. Yes, okay, I'm so happy to see people saying sell and get out break even, because you need to stop thinking that way. All right? But that is the honest truth psychologically, and we have to change the way that we think psychologically. We're like, "Oh, I got back to there, I got to get out break even, just take my money and run, live to sell or live to trade another day." And that's literally exactly what happens. That's why these act as such strong areas of support and resistance. So if you have, the most sellers, buyers and sellers taking place at this area here, the next time we touch it, we're going to have the most buyers and sellers again, because you have people like, oh God, let me get out. I was down for 2 days or 1.5 days or whatever it was, right? So we're happy to jump out here, break even, and we need to learn to get out, you know, closer to the top. When we start seeing indicators to get out, um, like this inverted hammer, those are both warning signs to start getting out of trades. But that's stuff you can focus on later. Or this massive wick on this day. Like, that's a ton of selling pressure, right? So that's POCs in a nutshell. You think like a market maker here, large limit order. If they're trying to buy a lot of shares, they don't move that limit order. So the next time price comes here, it's going to rocket up. Or at a minimum, it's going to start consolidating sideways there. So now, if we look at these POCs, I need to take this one off because it's in the way. Actually, I probably put that there for a reason. I did. So you can see here, this POC here, even though it was touched a lot, boom, 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 tons of touches, rips up, comes back down, goes through this POC, and then, down and comes back up here. This POC acted enough as support and resistance that another POC formed right next to it. At this point, I take this one off my chart because I don't need two POCs, a centimeter away from each other. I can already say, this area here, which would have included that previous POC, is going to be consolidation. Like, I mean, I'm not being super accurate, but where there's a POC, there's going to be consolidation, close to it. So like I said, it acts as a magnet, and once we get there, acts as support and resistance. So here's that December 6th virgin point of control. Like, you cannot make this up. They are so strong that it got pulled like almost exactly to it. This is pre-market or after hours, sorry. Um, got pulled almost exactly to it. Those limit orders started filling, tapped it again, started filling. Other than this wick here, we really weren't able to get through it. And so that's how powerful these are. Like, I can't even emphasize enough um, how life changing these POCs are. This is how I'm able to tell people, like, oh, such and such stock is going to go to this price. And be, depending on the stock, sometimes pennies off, sometimes a couple of dollars off on the bigger stocks like Tesla or whatever. But with these POCs, you can pretty much predict within a few cents or a few dollars where price is going to go. And it's very, 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 very easy. So how I trade, um, I have like, I don't know, 30 tickers that I'll every night after the market closes, I'll draw my POCs on. And I mean, once you've got 30 tickers, adding 30 POCs is not a big deal, and erasing ones that are no longer important doesn't take very long. But when you first start, um, it it'll take a little while to get all those charts done. But once you have it done, if as long as you stay on top of it, you're just adding like 30 lines a day. Um, and so, like I said, just label them so you can easily see what date they're from and if it's virgin or not. And once it's not virgin, you just change it. Um, just take the V off. Um, the reason that the data is important is POCs generally only act as support and resistance for about 30 days. Once they've hit 30 days, they pretty much lose their validity. Or if they've been touched a lot of times, like this one here, it was touched here. And then on this day, it was touched here, and then touched a bunch more this day and a bunch more this day. Um, and then over here, touched even more. The next time we get back to this area, Um, this particular one probably won't act very much as a point of control, but we have four more that are basically right on top of each other. And again, I would just put the line here essentially, but like this whole area is going to be an area of consolidation um, because you have so many POCs on top of each other, right? So, like I said, the POCs they lose their validity after about 30 days, but the virgin point of controls they will remain like pretty potent um, much longer than 30 days. So like that's why it's okay to have a December 6th VPOC on your chart, and you can see it's respected here. And even if it went, a month further out, it would be respected still. So really good, important stuff. Hopefully everybody is following along and understanding. It's not too complicated. So the key points about points of control, in my opinion, they act as support and resistance. They are completely objective. They're not subjective. Like you can't say, "Oh, I think there's a point of control here." No, there either is or there isn't. Whereas with support and resistance, it's very subjective. People just draw, lines or squares on their charts, and they say, "Oh, there's support and resistance here." And to a degree they're right, but you don't have that hard factual line where with 100% certainty whether there is or isn't a POC at a specific area. um, then the other key thing about them is they also act as magnets for price, especially the virgin points of control. On this day, like, if you see red, it's getting pulled here. There's just no question. Yes, VPOCs are stronger than regular points of control. That's why it's important to label them as VPOCs versus just POCs. Very important to distinguish the difference between POCs and virgin points of control. Um, so now let's jump into our value area. I'm trying to find like a good one to look at for you guys. or I'm sorry, we're going to start with volume profile, and then we'll get into value area. So our value area, I don't know why I keep saying that. Our volume profile is going to be this whole yellow and blue, basically like volume graph off to the side. Sorry, Ronnie, the video should not be blurry at all. I'm streaming in 1080p. Quality looks good. Like I'm watching through YouTube and, of course, on my own screen, and the quality is good on both. So, our volume profile here, Ronnie, you might want to, like, I don't know, restart your computer or your internet if you need to. 720p, that's weird. Why is it in 720p? But okay. 720p is good enough. um, so this here is our volume profile. Andrew P, we have the same initials, dude. That's weird.
I was saying that earlier.
Whoa. Oh, you're in. Okay. So
Yeah, I'm watching.
we have the volume profile here, and basically this just represents all of the trading that's taken place during the day, buying and selling both. And then we have these areas that form that look kind of like a shelf, right? I actually like to refer to them as stairs, but they're really called volume shelves. Um, so this one here, you can see it's really shaped like a shelf. Um, this one here is shaped kind of like a P, right? And so anytime we have a P, we are probably having a bullish day. So a P on the volume profile means we're having a bullish day. If you see, let's see. Wow, why is it so hard to find an example? Oh, here we go. If you see what looks similar to a lowercase b, this is going to be bearish and you're going to probably be seeing downside. So actually, I want to get down to the 3-minute time frame so we can get a better look at volume profile here. Oh, this is a good day to look at. This is great. So I'll try to make this as big as possible while keeping everything on the screen. There we go. So there's some key things to look at here. So like I said, this whole thing here is going to be our volume profile. This area that's highlighted here is our value area. So the value area is where 68%, if you have it set to 68, like I said, some people like 70. I like 68. So this area here is where 68% of the buying and selling took place on this day. And so what I was talking about, here we have a bit of a volume shelf. Here we have a bit of a volume shelf. Here we have a bit of a volume shelf. And here we have a bit of a volume shelf. Anywhere where there's a shelf, they act like stairs. So if you think about, if we're looking at this backwards, if you're walking up a set of stairs, you can stand here and you have support, right? Support and resistance. Excuse me. You have support and resistance here. So you can stand on this stair. You can't stand anywhere between this stair and this stair because there's nothing to support you. So you can move from here to here, but it's one swift motion. You can't just, stop here, whatever. You're going to go from this shelf or stair to the next stair quickly. Same thing here. we can go from this stair to this stair, and we can stay here for a while, and we can stay on this stair for a while, but we can't stay between the two because there's nothing to support us. Yes, so volume profile forms live with the market, but these shelves will form and they'll still act as support and resistance, as you can see. So here, this shelf acted as support and resistance here, and then it acted as support and resistance here. And once this shelf is, you have these two shelves, and you have this empty gap here, you know, on this trading part, you don't know, you know, what's going to happen because this shelf hasn't formed yet. If it had, that would make life really easy. You can take puts here down to here. But I'll show you exactly how I would trade this. It's actually very simple. Whoa, what am I doing? It's actually very simple. There's a bear flag here. So you enter the bear flag and play puts. You just don't know exactly where to get out. But so once we have these shelves established, or like I like to call them, the stairs, I'm just using the technical term that people use. So they're called volume shelves. I like to talk about them like they're stairs because it's an easier concept. Like, you know, if you're walking up a flight of stairs, as long as you have a stair to stand on, you can stay there as long as you want to. If there's no stair, you're going to fall, right? So that's how we think about these volume shelves. So this whole area here, I have support where I can just chill and I can stand on this shelf. Once I get into this open area, I just free fall until I get to the next shelf. If I go up above, I better rip up until I get to the next stair or shelf. If I go down, I'm ripping down until I get to the next shelf. So let me just draw. And you guys might think I'm looking over here at the candles. I'm looking over here at the volume shelf. So for drawing this square, I'm looking at the volume shelf. I'm not looking at those candles at all. I can see where the major area of trading is, you know, from these volume candles here. So if we start drawing these areas on our chart, we have a really easy idea of where support and resistance is on any given day, supply and demand, however you want to look at it. You know, and we technically also have just ugly choppiness up here, but this is really, this was pre-market and also at the open. But you're not trying to trade anything in this area. This is all just, we're looking for these moves. So again, once you know where these shelves are, it's very easy to know price can go from here to here, from here back up to here, from here back down to here, in pretty swift movements. So it's very important. This is, gosh, this is like a double distribution day. It's kind of a funky day. You have your typical days, which, you know, like you open and you could go up or down. And then you're going to pull back and then come down again and back up again and back down again. This, we had distribution at the top and distribution at the bottom and some, yeah, it's kind of weird. It's a weird day, but it's a good day to look at as far as the volume profile, because we have so many great shelves that act as support and resistance throughout the day. So right now you might be saying, wow, like, how do I trade this? You know, this hasn't formed yet. And again, you just start drawing your technical analysis. The easiest place to start, in my opinion, is looking for bull flags and bear flags. And what I'll do is I just draw the bottom of the bear flag or the bull flag. I don't need both. Right here. And there's a few ways you can take this trade here. You want to think smart. I'm going to zoom in really close here because we're going to look at this like on a macro level. Um, so technically, um, your trigger is going to be right here. Is this a POC? Has to be a POC. What is this line? That's a POC. I just didn't put the date on. So technically, your trigger is actually right when it leaves this POC. I'm going to take this green box off so that this stuff's a little bit clearer. Sorry. Um, so everybody should be able to see this. I'll draw the whole flag just so there's no confusion. You take the top to the bottom. You draw the top or the bottom of the flagpole, I guess, depending on how you're looking at it. As a bear flag, this would be the top of the flagpole. I mean, the top of the flag, but upside down. Um, and so this is actually like a bear pennant. Okay, you can see this. It's a pennant-shaped triangle. Um, and so with a bear pennant, we're always looking to play the break of the bottom of the triangle. Um, technically, you could play either direction, but the move should be down. Should. um, but so technically your entry is going to be right when we break out of the pennant, which is right here where this POC is. And that's going to be your riskiest entry. And there's a few reasons why this is your riskier entry. You can see like we pull down and then we reverse and come almost right back to our entry point. And then the next candle, um, we open, pull back actually above our entry, and then come all the way down and end up closing here. Um, and so that's why this is your riskier entry, because you're normally going to see some kind of a pullback before it goes. And so your safer entries are going to be either at the last touch of this pennant before it broke. So on this candle here, the wick of it, that would be your entry. And the safer entry is always going to be the retest of your trigger. So I'll try to find an example later, but a lot of times you'll have a trigger, and the first trigger will make a small move. Let me just draw. Um, so let's say I have, actually, let me draw a trigger. I need to turn off my magnet. So let's say that's my trigger there. I'm waiting for a break of a bear flag, and my price comes down. And then right after it comes down, I get a pullback. And then from there, it retests my trigger again and goes. Now, a lot of traders will take this initial break of their flag and play it down to here or as close as they can to the bottom, and they'll take their profits. And then when it retests, they'll enter again and they'll play it lower. Because pretty much every trader will tell you the retest is generally a bigger move than the initial move. The only exception to that is when you're having like a trending day and the price just goes down and it never comes back, or goes up and never comes back. Obviously, you never get that retest to enter the trade. But your safer entry is going to be the retest. And you might miss trades because you're waiting for the retest, and that's okay because there's going to be a million other trades you can take. So, yeah, the red line is the POC for that day, one. So, that's how you play, like the break of a flag. If you want to be super conservative, and this actually would not be a bad idea, do you see this big wick here? Um, you could have like potential support and resistance at this wick. So you could actually put a line here and say, you know what, because that wick came down so far, I'm going to use this as my entry, my safe entry for my puts. And then as soon as you see this is like a tweezer bottom. It's safe to get out of that trade. Um, this candle here is a little scary as well. But so yeah, these tweezer bottoms here, this is like a reversal sign, or a tweezer top would be a reversal sign to the downside. Of course, nothing is 100% in trading. So yeah, but just, pay attention to them. Know that you might be looking to get out fairly soon. Where would I place a stop loss after entering? Zach, so I do not use stop losses. And if somebody tells you, or if somebody recommends using like a stop loss in options, they're not your friend. So, you know, us as retail traders, we have access to level 2 data. Level 2 data, um, we can see orders that are being placed, the bid and the ask. Market makers have access to level 3 and level 4 data. So they can actually see our limit sell orders. They can see our limit stop losses. They can see every order, stop losses, and limits to get out of trades. And market makers are really smart. And if they're able to, use a little bit of money to dump the price of a contract down low enough to pick up your contracts and then ride the wave up, they will do it. So if you use a hard physical stop loss, you'll get stopped out a lot. And the market makers will be taking advantage, whatever it is, dropping the price of the contract $20 or whatever to scoop up your contracts and then let the play run out. So like, market makers know there's a bear flag here. Um, they know people are going to be entering puts here, and they probably did it here, 3 times. Like, oh, let's pull back right after we break this bear flag. Let's pull back, pick up some contracts, pull back, pick up some contracts, pull back, pick up some contracts, and then sell down here and make a grip. So you should never use a physical hard stop loss. It should be in your head. You should have a mental stop loss. And that's for you to decide where your mental stop loss is. But, you know, as a newer trader, it should be a percentage. So you should be shooting for a 2-to-1 risk reward. So if that means that you're shooting for 20% profit, you should be selling at negative 10%. If you're if you're trying to get 40% profit, you should be cutting your losses at negative 20%. Now, if you really, really, really think about this, and like, I know I'm not going to hammer this home hard enough, but if you maintain that ratio 2-to-1, no matter what, like if your contract makes it to 30, like if you're going for a negative 20% to positive 40%, if your contract goes to 30% and then ends up going to negative 20 and you sell there, yeah, you could have grabbed 30%. Um, and instead you took a 20% loss. But if you maintain that consistently, all you have to do is be correct 34% of the time, or 34 trades out of 100, and you'll be profitable. When people start getting scared and exiting trades too early, and then exit trades too early, or let their losers run for too long, which is what a lot of traders end up doing, that's when you get your cheeks clapped, like Tuco's sister said. So yeah, you really, the psychological game is the hardest part of this game, and so you have to do 2-to-1 risk reward, whatever that looks like for you. It could be negative 10%, negative 15, negative 20, negative 30, and then get out, positive 20%, positive 30%, positive 40%. People that shoot for like 100% winners all the time, they end up blowing up their accounts. The way you go for 100% and 200% winners is, let's say I buy 100 contracts of Apple here at the break of this bear flag. I play them down to 40%, which is my typical goal for taking profits. And I can sell 8 or 9 of them there. And I can leave that one runner to go the 100, 200, whatever. Um, I saw a really good quote the other day, and I'm going to share it because if I am able to like land this one thing with everybody here, you'll be much better traders going into tomorrow. The difference between a successful trader and an unsuccessful trader is the successful trader will do 4 things. They'll take small losses, they'll take break even trades, they'll take small wins, and they'll take big wins. The one thing that distinguishes a successful trader from an unsuccessful trader is the unsuccessful trader will take big losses. So really think about that. You need to cut your losses quick. It doesn't matter. There's always another trade. If you jumped in this first, um, Lloyd, if you start using active trader, you won't have that problem as much. Um, if you hopped in this bear flag right at the break of the flag here, and it pulls back and it goes, past your 20%, negative 20% stop loss, hop out. It's not a big deal. Because when you figure out, oh, I probably should have took this safer entry, or maybe even this safer entry here, and you get, a break and a retest and another retest, like this is where you're jumping in, or this is where you're jumping in if you're being really smart. You see this big wick and you go, I'm not going to get in here and have it bounce here on me and reverse back up. Or if you get in here, you need to have a plan to get out here just in case it does look like it's going to bounce, which is exactly what it did. Okay? So you want to look at the big picture. Hopefully I'm answering the questions that are coming up. Oh, how do I draw a green box? So if you're using TradingView, you would click this arrow here on geometric shapes, and you would select the rectangle and you click once and then drag it to wherever you want the box to be, and you click again. All right. So right now, everybody should understand these volume shelves. Everybody should understand POCs. And then the only other thing that I have to talk about as far as the volume profile is going to be the value area. Value area is huge. So this yellow shaded area, so we can pretend really quick, because I know this is factual. At one point in time during this trading day, the value area would have been right here. And it would have been after we came here and consolidated here, came down, consolidated here, and shot back up and came down, consolidated, and went. And this is actually, it's rough. But there's a rule with the value area. So like I said, the value area is where 68% or 70%, depending on your settings, of the trading took place on any given day. Once you recognize you have all of this choppiness, you're not looking to get in anywhere in here. So you should put a box around this and say, oh, this is an area of consolidation. I'm not trying to trade any of this mess, because you're going to get eaten alive. So this kind of takes away from what I'm getting at a little bit. So you guys can see this line here that represents the value area. This wick doesn't count because those are just wicks. But where I actually leave the value area for a few candles and then come back down and cross back over into the value area, when you enter this value area here, there's an 80% rule. And this is massive, because if you can do this, you can make money. So again, we knew our value area was here. earlier. At the end of the day, it became here. If I turned on replay and clicked here, I guarantee you my value area is going to be just this section right here. But so if you, as a trader, can say, okay, we just left the value area. As soon as we come back in, I'm going to take puts. I'm going to play it all the way down to the other side of the value area. 80% of the time, you will be correct. And 80% of the time, you will make money. Does the value area include the darker portion of the volume profile? Note the value area. So this shaded area here is not the value area. The value area is the highlighted area in the middle. So this whole thing is the value area. But at this point in time, 10:24 in the morning, the value area was just this area here. And I can tell you that because there's consolidation here for this shelf, and there's consolidation here for this shelf. And so this becomes our 68% of our trading area. But so, you know, even if this area was smaller, if I move this line and say this is the value area, it's not a big deal. This is a massive move. If you can consistently take a trade here and get out here and do that 80% of the time, you're rich. Hang on one second. I'm going to open my window. I'm getting pretty hot.
Could you turn on the fan?
All right, sorry about that. I've been slowly removing layers of clothes and I'm still like sweating.
Can you turn on the fan?
No, I cannot. Oh, sorry. I'm answering my son in Discord in voice while I'm streaming on YouTube. So you guys are probably like, who is he talking to? um so yeah, so if you can catch these moves, again here, same thing. If you were to take calls when we cross into the value area here and sell at the top of the value area here, boom, 80% of the time, over and over and over again, these trades are simple. So really, you want to have volume profile on your screen. You want to be aware of it. You want to be aware of what the stock is doing. And like I said, if you only traded volume profile all day long, if you only traded value area all day long, from the time the stock crosses over into it to the far side of it, 80% of the time you'll be correct. 80% of the time you're going to make money, and you'll be set. So Andrew, you can see here we have 1, 2, right? 2 retests of the value area. And you can do this on a bunch of stocks, you know. But yeah, I mean, there's days where you see, you know, generally you see like 2 retests of the value area, sometimes 3, 4, 5, 6. It just depends on the day. If it's a trending day where you open, and actually, I'm sorry, this is not double distribution. This is a trending day. If it's a trending day like this, you're not going to see a lot of retests of the value area because, you know, the stock pretty much opened and went to the far side. Like there was a little bit of wiggle getting there, but not much. Whereas most trading days, you know, open up, down, up, down, up, down. And so you'll see a lot more retests of that value area. So everybody here should be really excited right now. Because if you can consistently make 80%, or I'm sorry, if you can consistently be green 80% of the time, you should be green every single day of your life. No, I use the value areas the day of. There's one exception, like I'll look at larger time frames and look at the volume profile for like you know, over a day period versus the 30-day 30-minute. And I'm glad you actually asked that, because when you're drawing your POCs, you want to use the 30-day 30-minute chart. This is really important. So you can see on the 30-day, 30-minute, like this POC here will move when I switch to the 3-minute time frame. So the line is here and my POC is up here. That doesn't matter. This line will be respected on every time frame, regardless of the fact that it moves. But you want to plot them on the 30-day, 30-minute, and then they will be respected on every time frame. I'm going to take all these boxes off because it's just like my chart's going to start getting confusing for no reason. All right, so based just on volume profile alone, you guys should be pretty amped right now about being able to make trades that are correct 80% of the time. Let me get some more of these lines off of my chart, take away from some of this confusion. So me as a trader, how I trade is I'll watch that value area. And if I see, and again, this is really important because I had somebody today tell me like, oh, I used that 80% rule and it worked great. But they weren't using it correctly. So I want to make sure you guys understand it correctly. I mean, it worked in their favor, but I had to correct them because I don't want them to get wrecked. So like I said, this left the value area and it went, it's way out of the value area. Like it curled and then came back. This is where you enter. You don't enter here. Like it might go from here to the far side, but this is not leaving the value area. This here is leaving the value area. Okay? Correct. So the entire yellow and blue area is the volume profile. The highlighted area is the value area. Let me grab a sip of water. Hang on one second. All right, sorry about that. So I use this value area for these 80% trades all day long. Every time I see it cross, I'm going to take, calls this way, puts this way. And then I'm always looking for my technical analysis. So like here, as soon as I recognize that I have a bear flag, I'll draw my bear flag. And I actually do not draw the pole because I don't need it. And I don't draw the top of the bear flag because I'm not trying to play the break to the top side. I'm just playing the downside. So I'll just draw a line here and I know this is a bear flag. I can see it. But having that line there, just as a visual representation will help, recognizing when to enter the trade. And I'll also throw a line like, oh, here's my safe entry. This is where I'm going to actually enter on the break of this bear flag. Down here at the bottom here, when I see this consolidation start forming, I'm basically going to be like, I'm not going to take any trades in this area. And that extends over here as well. So I recognize I have consolidation here. I probably don't recognize it, until like this candle or this candle. And then I'm putting a box around that area. If I recognize, that I have candles extending down, and again, I wouldn't, so if I drew this box here, like on this candle, I'm not jumping in a trade here because I'm looking for a retest and I don't get it. This is why the retest is so important. But when I don't get a retest here, I go, oh, okay, I need to pull this box down further. So here I have a consolidation area. kind of nice that my consolidation area also lines up with my 80% play here from the value area. Um, but if this wasn't an 80% value area, when I broke the box here, um, I can take calls here, or if I'm being safer, I can wait to see if I get a retest here. If I don't, I could still hop in the trade here on this candle. Again, that's going to be more risky than waiting for a retest. And again, taking it right off the bat when it rips through is going to be more risky than waiting for the retest. But you have to determine for yourself what your risk is, how much you're willing to risk for each trade. Some people are more risk averse and some people are less risk averse. Um, and so, yeah, I mean, here on this trade, we have the benefit of the far side of the value area. At the latest, you would want to get out at the far side of the value area. So on this candle here, and as you can see by this wick, that is a perfect exit. If you didn't get out here, this inverted hammer should scare you out of the trade, I hope. But really, you should, um, you know, if you keep doing this trade, I'm sorry, that was probably really loud in everybody's ear. If you keep doing this 80% trade and you feel comfortable taking it from one side of the value area to the other, and you can keep repeating that over and over again, even if you get past like your 40% cut zone, go for it. But make sure that you have like that mental stop loss at 40% if it does pull back to get out of that trade. But if you keep doing it over and over and you feel comfortable letting it run from one side to the other, and it ends up being like an 80 or 100% trade, run with it. If it's working for you, run with it. If you're comfortable taking those trades from one side to the other, do it. But just make sure that you never go below like your 40% if you let it keep running. Okay? And then same thing here. I'm going to recognize I've got a bunch of consolidation here. I'm not going to be looking to take trades in this area. So here again, when we enter, if we didn't have the value area here, we can take the retest on any of those candles of the break of this rectangle consolidation. And I'll also say, this you probably won't do when you're trading, but rectangle consolidation is generally a measured move. So if I go from the high to the low of that consolidation area, it's negative 0.29%. And if I draw that from the bottom of my rectangle down, I'm pretty much guaranteed a negative 29% move. Oh, sorry, that popped off my screen. But so right around here somewhere. And it's almost perfect. It lines up with where we started chopping sideways for just a minute. And then we finished the move all the way down to the far side of the value area. So for me, looking at Apple really quick. And something really important, don't try to trade the first 5 minutes of the day. The first 5 to 10 minutes of the day, you have so much emotional buying and selling happening. If you think of yourself as a trader, again, you always want to put yourself in, you always want to put yourself into other people's shoes. So first thing in the morning, if you have swings, or if you see like a stock that's ripping up that you want to get into, the first thing in the morning, you're emotionally trading. You're either trying to get out of your swings or buy into something that's moving quickly. You don't want to be the person trying to get into something moving quickly, because that emotional selling and buying is enough to cause something to start moving one way, like we see here today on Apple. I love that it's just a perfect example. You know, um, we opened here, or wait, sorry, we opened here, came all the way up, pulled all the way back down, and closed here. And then we have a pullback, and then we go up. So if you try to trade, here to here, yeah, you can make money. Um, here to here, you can make money, but these are all super quick moves. These are 3-minute candles. Um, if you keep trying to trade this first 10 minutes, you're going to lose. It might work out a few times for you, but all in all, you're going to lose. So this is a perfect example. It has to pick a direction. This is where you go, oh, okay, beautiful setup. Let me take this trade. So for me, how I trade, I'm not taking a single trade on Apple until this line right here, where I broke my my bear flag. I also got past this little area of resistance, and boom, I'm getting in the trade right there. I'm not waiting for a retest on this. Taking the safer entry here is my retest essentially. This is that what you're talking about, Kaswani? Thinky, I check the clouds, but really a lot of the time, a lot of the time, my chart will look like this. Because I don't need all that other noise. There's nothing wrong with having all this. Um, this shows you the shelves. But once you get good at this stuff, like you can mark your value area on your screen. Um, if you want it on, it's not a big deal. But so I know my value area is here. I've already marked it. Um, I'm going to take the break of this bear flag here. I'm going to take the safe entry. I don't need a retest because this is my safe entry. I'm going to play it down, take my 40% gains. I'm going to wait for the next trade. Here, again, one of two things. If this wasn't my value area, I would recognize the break of the consolidation area and I would play this up to this next consolidation area. And again, I would know it's going to be a consolidation area based on the volume shelf. Um, once I see all this consolidation here, I'm going to draw this box here. I will play this, if this was just the value area and not consolidation and consolidation, I would do the 80% rule here and take my 40% profits. Are you talking about on this bear flag, Crystal? Or are you talking about this here? There's going to be a delay, so I'll just keep talking until you answer. But here, again, value area, I would take the break of it. I think Crystal might be asking about this, these here, but I already have, like this box is not very good because I should include the bottom of those wicks. And I'm not looking to get in on wicks. I'm looking to get in on a retest. Um, so this trade I wouldn't take. I might take it on this second candle. But this wick might tell me, there's selling pressure, let me wait. This wick's telling me there's selling pressure, let me wait. And I probably get in here. Get out at 40%. I might get scared here. I might get out for whatever, negative 20. I'm not sure because I'm not looking at the trade like live. I probably would have got faked out here. I probably would have took my negative 20 loss and lived to trade another day. Above the 168. So yeah, you're talking about these. Sorry, my box wasn't really good. It should have included these candles here, which includes these candles here. And I'm not going to be getting in on wicks. These wicks would have happened so fast, like because we're looking at the 3-minute time frame. Crawling, I didn't ignore you. I'll talk about timeframes more at the end, but I'm pretty much always trading the 3 minute. I do look at the 1 minute and the 5 minute, uh, but that's where I'm comfortable. I'm comfortable trading on the 3 minute. The 3 minutes fast enough to get, like find setups and get good movements and trades. 1 minute chart, you have to be in and out like within seconds, really, really, really fast. Yes, I play the value area between the volume shelves. Are you talking about here, Crystal? If you're talking about this, these wicks, again, they're going to happen so fast. I wouldn't get in. Or maybe you're talking about these. If you're speaking about these ones here, it's like this candle here is telling me not to get in. And these as well. This is a tweezer top. And this candle, I don't know if you can see it, but that's a shave top candle. Again, this is why I say you have to wait for the retest. See this, the top of this candle here? There's no wick on it. So that means it opened with so much selling pressure. It never had a wick. It just went straight down. So no, I'm not jumping in that. Crystal mentioned a double top. Uh, maybe this. So like you can play double tops. This is a great, other than this being an area of consolidation, if this was not an area of consolidation, if you notice a double top, boom, boom, you can grab puts right here. And in this case, it played out. But I wouldn't take it because of this consolidation area. I would wait for the break and retest of this consolidation area. But yes, good eyes, Crystal. You absolutely could play this again if this was not consolidation, because it might touch here and then come back and just keep consolidating. It ended up being a good trade, but more often than not, you'll get chopped sideways here. Okay. So yeah, recognizing like double tops, triple bottoms, triple tops, double bottoms, all of that stuff is great. It's stuff that you want to add to your arsenal, um, and you want to look to take those trades. Like here as well, you have a double bottom right there. This candle here and this candle here. But if you take the retest here of this consolidation area, you're taking puts. And then the most important thing, which we really haven't touched on much, is you need to make sure you have enough volume to take trades. I said it at the beginning of the class. You want to, sorry, you'll want to read the book Volume Price Analysis by Ann Cooling. It will completely change everything about your trading in a good way. Again, you can trade just based on volume alone without even looking at candlesticks. You could trade just with the volume. And there's actually people that do that. I want to try to find something for you guys. I think. Why is my volume like so small? Maybe actually I can do this better in ThinkOrSwim. Sorry, bear with me for a second. I don't plan anything ahead when I do videos because I don't want it to be like pre-scripted where I'm like, oh, look at all these perfect trades. Because that's not realistic. I should get a good example of this though, so that it's easy for me to show people. Right now I'm looking for a volume anomaly because you want to watch for these things. Okay, I found one. It's not the greatest example, but it's going to have to do. So right here, price is going up. And down here, volume is going down. Again, it's not the best example, but hopefully everybody can see that. Price going up, volume going down. This is an indication to get out of this trade. So you always want to look for volume volume anomalies when you're trading. If you're in calls and volume's going down, you want to get out. If you're in puts and volume's going up, or like green volume going up, you want to get out. Yeah. On TradingView, you go to indicators and you search for session volume session, volume profile session volume. You have to have a subscription to TradingView to get access to this indicator. On ThinkOrSwim, you can get the indicator for free. But on TradingView, you have to have a subscription. It's worth the subscription, in my opinion, but that's um, that's my opinion. You know, you have to decide for yourself if it's worth $15 a month. It actually ends up being $21 if you sorry, if you want live data on on TradingView, you have to pay the subscription fee plus you have to pay $6 a month for live data. If you just want to get your POCs and all of that and put it into wherever you're trading, then you would just need to pay the $15 a month subscription fee, and then you could get the price lines to put them into your whatever trading platform you use. The one thing I would recommend is TradingView offers like a 7-day free trial. Take the free trial and then cancel your subscription like before it ends, and TradingView will actually reach out to you with a discount that you can use for I don't know how long, but you can get out a little bit of a discount that way. So that's pretty much it for that. I want to go over SPY really quick. And then I just want to leave you guys, like, this is my live chart from today. I haven't touched anything other than, um, like I know during the day I circled this area to show somebody in one of the Discord servers. I'm going to take that off of there because that's not serving any purposes. This is how I traded SPY today. I didn't take all of the trades. I know there was like a double top somewhere. Yeah, right here that I could have took. I think I was in the shower when this happened. Like my mentor was like, "Oh, you missed the double top," and I was like, "Dude, I was in the shower." So, um, yeah, you could have grabbed puts here. Um, I'm gonna throw this on here as well, but there's also a bear flag here that you could have taken. So again, I'm gonna take these off now because these are trades I did not do. I think I was in the shower for both of those. Um, but so this morning, SPY opened. Again, I'm not trying to trade in the first like 5 or 10 minutes. I recognize there's a pennant set up here. So I drew my pennant and I took the break of the pennant right here. The last touch of the pennant there on the candle before. Took this, got in, chopped a tiny bit, and then just ripped down. I took my 40% and called it a day. If you wanted to be safer, I mean, actually, the pennant's a perfectly safe play. But then you also have a bear flag here you can play. Whoa, what just happened? You also have a bear flag here you could play. So this stuff should start to get pretty easy. And what I really tell everybody when they're starting out, slow down and step back and just take your time. There's no hurry. There's a million trades every day, millions and millions and millions of trades. And you literally need like 3 or 4. So that should be your goal, like two to maybe maximum of 6 trades a day. Shoot for your 5% on your portfolio. If you hit your 5% in two trades, you're done. Don't overtrade. Don't give back any of that 5%. Take your 5%, call it a day, walk away, and be done. But so you can play the break of this pennant here. Again, I played the last touch of the pennant, so it's this wick here. I entered the trade here, got my 40%. You could have played this bear flag here, but I think I was still in this trade from taking it here. I didn't play this bear flag. And then I noticed another pennant forming here, which you would play to the upside. But then also if you see this yellow line on my chart, I'm pretty sure I showed you guys this at the beginning of the video. I have like a double bottom here that I drew on here before. Yeah, I think it's these two here. So I have this double bottom. I was kind of expecting a bounce here. So I played calls up here. I think this was a really quick trade because the market was being funky. I think I just took 20% here and called it a day. And then I didn't trade. It just started kind of chopping sideways, consolidating, what have you. Once I noticed we have an uptrend going here, I was looking to play the break of this uptrend. I don't think I entered. Oh, yeah, I did. I took another trade here at the break of the uptrend. Again, I grabbed 20%. I got in and out of trades really quick today. I only made 2% on the day on my entire portfolio, but I'm good with that. So then, like I said, there was this double top here you could have played. My mentor was giving me a hard time about not playing it. I'm like, dude, I have to smell good. He also gave me a hard time about not playing this bear flag. Actually, he didn't say anything about the bear flag. But so you have another bear flag here. And again, I just draw the bottoms of them. That's all you need. Came down here. I got out of the shower at some point in time here. I noticed uptrend again. Played the break of this, which was also the break of my double bottom. Played puts down. I grabbed another 20% here. And then notice I have another bear flag forming. I played the break of this bear flag. And again, it's the same thing. I should show you guys all of this. I'm taking the last touch. So my entry was here. If I was playing this one, my entry would have been there. And on this one here, my entry was here. Excuse me. And on this one, I got a bigger move. I took my 40% on this one because I think at this point, Biden was speaking. And I'm like, wow, if the market's moving this red, it's going to make a good movement, like right before the market closes with Biden speaking and everything. So he must have said something in his speech that caused all this bleeding. So those were my trades. That's literally, this is the only thing I traded all day. I took one trade here. Sorry, yeah, one trade here, one trade here. So that's two. Um, missed this one, missed this one. Played this for a third trade, and then this was my fourth trade of the day. And that's it. That's all I traded all day long. And so moving forward, um, again, for anybody that's newer to trading, this doesn't have to be complicated. You don't have to look at 20 charts. You don't have to look at 4 charts. You don't have to look at 6 charts. I really, really, really highly recommend um, you trade SPY, draw your POCs. Those POCs will help you with your exits. If you're not quite at 40%, like if you're coming up on a POC, it's cool. Take your 20% profit. So yeah, focus on just SPY, one chart. Just focus on one chart. If you're not feeling confident with your trading, if you've been getting beaten up, spend a day or two just drawing your patterns. What I really, really highly recommend for newer people. So if we just completely clear this chart, right? What I really recommend for new people is say, oh, look, I see a bear flag. And if you want, draw your pole, draw everything. And then sit on your hands and go, oh, let me see what would happen if I took the trade at the last touch of my bear flag. Oh, look, I would have made money. Cool. And now we wait and look and, oh, we've got another bear flag. What would have happened if I played the break of that? Oh, I would have made money. You would have to have this line on your chart already from the previous trading day, but if you have it and you go, oh, double bottom, I don't know where it was exactly, but we'll just call it good there somewhere. It's not good because it was lower, but it's okay, whatever. We play the bounce of that double bottom, you know, we make money. Here you could even take calls when you break out of the double bottom again. That's going to be more risky. And then here you should be recognizing, okay, I'm in an uptrend here. So you're looking for, a break to the downside. We all would have got faked out on this if we took it. I guess I'm smart for taking a shower here. And then if you're paying attention and you see it, you've got that double top here that my mentor will never let me live down. You're going to play the break of this. This is going to be a more risky trade, but you can do it. Then you should be noticing we have a bear flag here. Like these things should just start popping out at you. Very easy. And then we have an uptrend here. And then we have another bear flag here, right? So moving forward, your goal, you download a chart pattern cheat sheet, and at the beginning of the trading day say, okay, I'm going to take 2 chart patterns. Bull flags and bear flags could be one. And then I'm going to draw like rectangle consolidation on charts, and that'll be 2. And you can start playing the break of your bear flags, bull flags, and your consolidation areas. And then the next day you can add in, like your triangles and pennants. And play the break of these if you're feeling comfortable, at least. Like if you're feeling comfortable with bull flags, bear flags, and rectangle consolidation. Then start looking for triangles and pennants. Once you're comfortable with those, start looking for cup and handles. Um, the hardest one to find on a chart is going to be like head and shoulders or inverse head and shoulders. Start looking for those. Once you have all of the chart patterns down, then switch over to looking for candlestick patterns. You'll want to start noticing things like abandoned babies and hammers, long leg dojis. So this here, whoa, let me zoom in. This here is a long leg doji, which is normally like a sign of a reversal. Um, these are all hangman, hangman. Yeah. This is a doji. Anyway, you just want to start learning to recognize all these things, shave top candles, your tweezer bottoms, things like that. So download a candlestick pattern cheat sheet. And once you have all of your charting patterns down, start learning your candlestick patterns. Once you start combining all of this stuff, trading gets pretty easy. I remember when I started and people would talk about technical analysis, I always say, oh, that's a bunch of crap. Like, that doesn't work. Why would I bother learning that stuff? Like, drawing a rectangle on a chart isn't going to do anything. There's no way that works. Or I don't know if it was just that I thought it was too complicated, and it was scary to me, that made me act like, oh, it's that can't really work. I'm not really sure exactly what my thought process was, but it wasn't until I finally said, I'm going to learn this stuff, that my trading actually started working. Like, I actually started becoming a profitable trader. And it's really not that hard. It just takes a little bit of studying. And like I said, if you just take a couple a day and focus on finding those, before you know it, like, you'll have all of them memorized, and they'll pop out on you on charts, um, you know, really, really easy. Like, they're really easy to find. Once you have them memorized. Sorry, let me take another sip of my drink here. Okay. Sorry about that. Um, but so that should be your goal going forward. Focus on a couple patterns. Either draw them on your charts and watch how they would play out. Also look for those 80% rules on the value area. Those are always great trades. Um, well, actually, that was the trade I was looking for over here, was the break of that value area. I don't have it on my chart right now, so I was confused. But yeah, there was the play of the value area from here to the top. Um, but so yeah, just get comfortable with the value area. Watch your volume shelves. Look for breaks of chart patterns. Draw in simple chart patterns. The bear flags and bull flags. And this stuff just starts to get easier and easier. And once you start banking 5% a day, you know, if you start with $1,000, 5% is only $50. But $50 will turn into, $200 a day, $500 a day, $1,000 a day, $5,000 a day. It grows quickly. Being consistent is literally, I mean, aside from risk management is the most important thing, bar none. But as long as you're using proper risk management, being consistent with your trades, um, your account will grow faster than you could ever possibly imagine. How do I manage two to
Hey,
one?
Dad, your stream's a little laggy on my end. I've tried refreshing.
Are you talking about on YouTube, Travis?
Yeah,
Oh, I'm not even sharing my screen here. I'm stupid.
but it's also a little laggy on your stream.
Yeah,
Like it looks.
there's always a delay on YouTube, or I
All right,
have it set to a delay.
and then how long are no, not delayed. It's like when you move your mouse, it's like a little bit
Yeah,
like glitchy.
I don't know why my trading view is lagging right now. It might be because I've had it open all day. I don't
Oh,
know.
okay. And then how long are you gonna be streaming for?
I'm almost done. All right,
And
so
then is Shorty doing a live tomorrow?
I don't know. How do I
Okay.
manage 2 to 1? Are you saying 2 to 1 risk reward percent when prices of contracts vary so much? 500, 20% loss versus 140% win. Well, a percent, Powell, is, negative 20% of 100 is 20. Positive 40% of 100 is 40. And 500 is going to be negative 100 is your 20%. And positive 200 is your 40%. So, it's math. It doesn't matter the size of the contract. You're shooting for the same percentage every time. Whatever you decide that is, if it's negative 10% to 20%, or negative 15 to 30, or negative 20 to 40, you just need to be consistent. Consistency is going to be the key. And you could recognize, like I did today, I was like, wow, the market's moving kind of wild. I'm just going to shoot for 20%. I can then just change, on this day, I normally shoot for 40% gains and 20% losses. But today I switched to 10 and 20 because the market was moving so wild. Um, Recap of the value area. Okay. Um, I don't really know exactly what you want for a recap, but so the value area on TradingView is going to be the area of the chart that's not shaded, or the area of the volume profile that's not shaded. Um, you have the 80% rule. So like here, this isn't a great example. Um, so for me to take this trade here, I want to see more of, sorry, let me find my brush. I want to see this leave more like this and come back. I don't want it to just be wicks coming out. I want it to actually be candlesticks up here and come back in, cross over into the value area. You can play to the far side of the value area. Even though this one is just wicks, it did actually work, but you probably would have got, faked out of this. Actually, this is the morning, so the value area wouldn't have even been formed for us to try to trade this. So this is where I took my, my pennant, and took the break of this. Um, I don't really know what else to say about the value area. Volume profile, this is just all of your trading, buying and selling that took place on any given day. Where you get the spikes is the larger areas of volume that were traded. And the value area is going to be 68% of your buying and selling volume on your chart. The value area does move throughout the day, but it's normally not big enough movements that it affects. If you think about it, so if my value area is here, this is where the most buying and selling is taking place. Um, and so if I'm crossing back into here, more buying and selling is taking place in this value area. And so the value area isn't going to move while trading is taking place in here. The value area will move when we go below it or above it and start trading, down here. Then the value area might move down, like it won't move down a lot, but it might move down a little bit. Or the value area might get smaller. Yeah, I mean, so this is Ronnie, this is a live video, so you can watch it anytime you want. I'm not going to be deleting it or anything. After I end the stream, um, it'll be there to be rewatched as much as you want. It also has a lot of the I don't remember what I was going to say. I'm sorry, I just completely lost my train of thought. It'll be there to be rewatched if you want to. I have other videos on my YouTube where I discuss a lot of the same things. It might be worth watching, different videos in case I accidentally skip something. I tried to be extremely thorough. One thing that's very important, I know I mentioned this, but I'll mention it again. Draw your POCs on your 30-minute time frame. 30-day, 30-minute to be specific. Like if you're using ThinkOrSwim, you want to use 30-day, 30-minute. Kleps, can you, rather than the breaks of the value area, can you play the volume shelves in the value area? Yeah, you can play the breaks of the shelves. So, like I was saying, um, and I don't think I actually covered this well enough, but where you have a volume shelf, anywhere where there's a volume shelf, the stock is going to be able to chop sideways. Here we have a volume shelf, we can chop sideways. When you see it break below these volume shelves, you can comfortably take trades. There's a good chance it falls, from here on the value area all the way down to somewhere about here. And again, when I'm doing this, I'm not looking at the candles. If I look over now, I can see that I'm pretty accurate. It starts chopping there. You can just tell by the size of these volume shelves where the stock is going to stop. On TradingView, it's just the 30-minute. You don't choose the 30-day, 30-minute. You just choose the, whoa. You just draw all over your charts. Yeah, you just choose the 30-day, 30-minute, and I'm sorry, you just choose the 30-minute. Apologize. Uh, yeah, wow, my stuff is getting really laggy. I don't know why. Probably because I've had ThinkOrSwim and TradingView running all day, and a bunch of other programs. I'm just trying to make sure that I've answered everybody's questions. Um, for people in Shorty's Discord, there's no. Shorty asked me to do a video just on volume profile, value area, and POCs. So I'm not talking about like the orbs tonight. Personally, I don't even trade with them. They're good. It's just a little bit slow for the way that I like to trade, waiting for orbs, and also like um, they're really good for finding areas to trim or to get out of trades, because they're fibs and they get respected pretty well. But I just use my 20% or 40% rule, so I won't be covering anything on orbs tonight. All right, so if you guys do have any other questions, just ask. I'm going to give a couple of minutes because I know you guys are watching this delayed, so I'll give you a few minutes to ask questions. But I will say, just going forward, um, if you're not feeling super comfortable with your trading, just slow down and take your time. Um, Start drawing on your charts, and if you're still not feeling comfortable, um, just draw on your charts and see how the day would have played out, and find that comfort. And then once you find that comfort, start taking the trades. It should get a lot easier if you just take a step back and really take your time. And if you guys follow everything I've said, draw your technical analysis, take the breaks of your technical analysis, take your 10, 15, 20, I'm sorry, take your 20, 30, 40% profits, take your 10, 15, 20% losses, and manage your risk appropriately. Um, like you guys, you can become successful at this. Just take a step back, draw your technical analysis, take the trades as they come to you. Don't force trades. Don't listen to other people's trades unless you really, really trust them. Um, and yeah, just rock out with it. I'm going to read through really quick and see um, How do I differentiate the difference between value area and volume profile in ThinkOrSwim? It's all gray. Um, Mine is not all gray. Mine is blue. Um, so right here, value area high and low, you just want to change the color to something other than gray so it's highlighted for you. Okay. So you can see my value area is very clear. I actually prefer this to TradingView because this is like super clear. On TradingView, I have to draw lines. It's hard to differentiate the shaded area versus the highlighted area for me. When is the next class? I'm going to be trying to do watch lists like probably 2 to 3 days a week. This will probably be the last class for this week, and also this weekend. I'll probably do another class on Monday or Tuesday. Sorry, I'm just reading through everybody's stuff to make sure I didn't miss any questions. That's correct, Ronnie. The book is A Complete Guide to Volume Price Analysis by Anna Cooling. If you need a copy, you can DM me. No worries, Crystal. Good to see you, Roses. Thank you. Anonymous, the best way to recognize a bull flag, bear flag. I mean, I'm not really sure exactly how to answer, but like, here's one here. Your pole and your flag, they don't have to be perfect. You have one here as well. This is just like, it's a bear pennant. So it's shaped more like a triangle. So if I were to draw it, it's something like this. And again, I don't really care about the top. I just care about the bottom because I'm going to play the break of the bottom. But this is my flag right there. It doesn't have to be perfect. The one thing with technical analysis is it's an art. It's not a science. It's not exact. So if I gave this chart to my mentor and he charted everything out on it, like where he would take plays, and I charted everything out on it, I guarantee you they would not look the same at all. Neither one being right or wrong. It's just there's no exact science to this. But like, sorry, switching from TradingView to ThinkOrSwim is a really weird thing. Whoa. If I grab this, there we go. So like this here to me is just great. I should have covered this in the class actually. You want to look for uptrends, downtrends, and consolidation. So this is an uptrend. We have what we'll call a higher low, higher high, higher low, higher high, higher low, higher high. Here we have a lower low, lower high, lower low, or I'm sorry, higher low, slightly higher high. And then if you were to take this trade where you break out of this uptrend right here, you take puts and you're good. Or you have a bear flag here. You have a bear flag here. You have a bear flag here. Almost have a bear flag here. But we end up going to the upside. And that's okay. We just don't take the trade. Let me read through more of this. Anyway, hopefully, Anonymous, that helps. I don't know what else to say. You're just looking for what would look like a pole and then a flag. And again, I'm not even worried about the top of the flag if it's a bear flag, and I'm also not worried about the bottom of the flag if it's a bull flag. So like here, I have a bull flag. I would just draw the top of this. I'm not trying to draw the bottom. I don't care what happens from there. The only other thing I can say about bull flags and bear flags is the flag itself cannot be 50% of the pole. So if this flag, came out to here, it wouldn't be a bear flag. Mr. Red Mask. So you're just going to look for the ones that are significant. Obviously, I'm going to take the most recent day. This one here. So you can see if I put a line here, it's being respected. It keeps getting touched. This one, yeah, I'm not going to put this one on. It's been touched too many times. I would grab this one. If you have questions, I would say just grab all of them. And then as you start to hone your skills, you'll realize like ones that are super close together, um, you don't need all of them on your chart, basically. But like so far, every single one of these is important. This one's important as well. It's being respected. I'm definitely not grabbing this one because this one's too close to this one. So hopefully that helps you out. I know it's, and it's really that just the POCs themselves are factual. The ones that you choose, I guess that's where the art comes in. Thank you, Crawlin. Sorry, just reading through all the comments again really quick. No problem, Ricardo. Awesome, Lloyd. Best of luck. No problem, George. No problem, Anonymous. How are futures looking tomorrow? You tell me. I haven't looked at anything, man. Here's futures. There's your futures for tomorrow. So we're doing pretty good. But I wouldn't let that fool you. I'm actually expecting a red day tomorrow. I should add, actually, I should have covered this during the video and I didn't. I apologize. I always watch ES, NQ, AD, and VIX when I'm trading. Um, if you line these up for the trading day, it's kind of hard now that futures have opened, but uh, let me see if I can line this up good. This is it's like here, here. It's disgusting. All right, you see that? Look at these two charts. If you didn't know any better, these are the same chart. And if I do the same thing with NQ, this is the same chart, right? And if I grab this, this is this chart turned upside down. These three charts upside down. Give me 1 second. If you guys want to stay around for this, I'll be right back. I got to open the door for my dog. All right, sorry about that. So, ES is one of our futures. If you're watching this, SPY and SPX and QQQ will pretty much move exactly the same as this. Same thing with NQ. Add. I normally have to look this up, but I'll try to do it off the top of the head, off the top of my head. Add is the advancing versus declining stocks on any given day. So today we had a pretty red day. So we opened with 1,233 stocks were in the green, and by the close of the day, 1,257 stocks were red on the day. And so this gives you a good indication of what the market is doing. If you're just watching ad, you can take puts all the way down here, take calls here, and go back to puts again. VIX, you guys should know this one, but VIX is going to run inverse of SPY and QQQ. So if VIX is going red, SPY and QQQ and our futures are going red as well. Okay, so these four things I always have on my chart. I'm always watching these when I'm trading. Like I won't take a trade without peeking at what futures are doing and what AD and VIX are doing. So these have kept me out of bad trades before. All right, so it looks like there's no more questions. Hopefully this was a helpful class for everybody. Most of you, know me in some way, shape, or form and have access to me. If you have a question, don't hesitate to hit me up in my DMs. Other than that, have a good night. Good luck trading tomorrow. Much love to everyone.